back, everyone, to our next session, which will feature leading impact investors from around the world, sharing their perspectives on how they see the fundraising landscape evolve over the next 12 months and what social entrepreneurs should be focusing on to raise capital in challenging times. So our moderator for this session is Andrew Ive, the founder and managing general partner of Big Idea Ventures. He'll be joined by three of this year's MB100 winning investors, Medea Nocentini, the founder of C3 and a senior partner at Global Ventures, Sandiip Bhammer, the co-founder and managing partner of Green Frontier Capital, and Victor Ndiege, who is the CEO of Kenya Climate Ventures. Over to you, Andrew, for the session. Thank you.
Thank you, Tom. Welcome to Meaningful Business 100. And today we're going to be focusing on the Impact Investors Guide to Fundraising. We've got some great people today. I'd love it if people on the panel could just spend a minute taking us through who you are. Medea, why don't you kick off?
Thank you, Andrew, and thank you everybody for having us here today. Super excited for the discussion. So I'm senior partner at Global Ventures, which is a venture capital firm based out of Dubai, covering Middle East and Africa. We have two funds fully deployed. We are fundraising as we speak. First close coming very soon. Third fund, more than 50 companies in our portfolio, typically seed stage, Series A, and some Series B. So super exciting time. I'm also the founder of a platform called Companies Creating Change, which runs accelerators for social entrepreneurs and impact-driven entrepreneurs in the same region. So very happy to be here, and I'll pass it into Sandiip.
Thank you, Medea. Thanks everyone for making the session today. My name is Sandiip Bhammer, and I am the co-managing partner and founder of Green Frontier Capital. Green Frontier Capital is India's probably first ever venture fund focusing on climate change. And we effectively invest in breakthrough innovation that has been delivered by really young, dynamic entrepreneurs in line with not only the United Nations, but India's Sustainability Development Goals, with a specific action on climate. Further, I also am an adjunct professor of sustainable finance at the University of Massachusetts, Amherst, where I teach the next generation of business leaders on how to incorporate ESG considerations into their decision-making process. Green Frontier is a relatively early stage. We invest in companies that run from the pre-seed to the Series A stage, and we encompass pretty much all the sectors that contribute aggressively to greenhouse gas emissions in India, and we invest in those companies that help reduce them. So whether that's food tech, ag tech, mobility, and so forth. So that's a little bit about us. We can talk a little bit more about it when we start the panel. Victor, over to you.
Thanks, moderator, and thanks everyone for joining us for this session. As said, I'm Victor Ndiege. I'm an impact investor. I'm currently the CEO of Kenya Climate Ventures, an impact investment fund based in Kenya. We work with climate smart enterprises offering climate resilient solutions for communities in an entrepreneurial manner. In addition to that, I am also part of, I'm an expert panel at the Clean Tech Group, which is a global outfit looking at surfacing climate smart, green transition initiatives and enterprises across the globe. Currently at Kenya Climate Ventures, we focus on early and growth stage enterprises. We have a portfolio of 20 enterprises in Kenya, but also supporting the region as an expert. Thank you.
Amazing. Thank you, Victor. So in terms of myself, I'm Andrew Ive. I'm the founder of Big Idea Ventures. Our mission is to solve the world's greatest challenges by supporting the world's best entrepreneurs, scientists, and engineers. It's our belief that there are people out there who are trying to do amazing things that are going to solve a lot of the problems and the challenges we have as a species. And it's our role at Big Idea Ventures to find them, to support them, to invest in them, to help them any way we can. We're global. We have offices in Singapore, New York, and Paris. We've made over 105 investments in young companies at this point. And we partner with some governments and global corporates to facilitate those young companies. So that's Andrew, me, and Big Idea Ventures. Let's now get into the kind of the meat or the plant-based meat, or however you want to think about it, the meat of the conversation today. The one thing I love, and there's many things I love about the audience, about the panel today, is that we are all working with very young entrepreneurs, and we're really at the coalface working with these amazing innovators and supporting them. What in terms of 2023, because I unfortunately we only have about 3 weeks left of 2022, can you guys tell me what you're really excited to find in 2023? What kind of companies, innovations, innovators you're looking for? What are you keeping your eyes peeled for in 2023? Victor, do you want to kick off?
Yes, thanks, Andrew. I will wish to kick off. Also, in my earlier introduction, I already mentioned what our focus is, and as a climate impact venture fund, we are really interested in promoting climate smart solutions. So our approach is really how we can provide capital and provide business growth support to entrepreneurs that are contributing to climate resilience. And as it is now, just a few weeks, COP27 closed, and I think the most material thing there is, leave alone even the funds commitments and every discussion that happened. I think it is across the board that climate change is no longer just a social and environmental issue; it is an economic issue. So across the globe, across the countries, everywhere, and that's why now we pull in closely in 2023, just to make sure that the economic planning of Kenya, for instance, as mentioned a lot, and a lot of commitments have been made, but I still critically think that there is need to trickle down resources to small and medium enterprises, which are actually the change makers when it comes to people's and market resilience. So our focus will continue to be very specific sectors like agribusiness, renewable energy, waste management, water, and of course forestry, to build the necessary carbon sinks that are required to help us, reduce on the kind of impact that we are seeing ahead of us. Also critically is, I will give you an example of Kenya, for instance. So we have around 7 million SMEs, Kenya alone. About 4 million of them are formally registered SMEs. Fortunately, these contribute to about 70–80% of the total workforce. So it's really a critical place where we need to put capital, but not only to put capital for the sake of it, but to ensure that the solutions that are being provided by these small and medium enterprises are actually aligning communities and markets to climate resilience. So in 2023, that's where I would put most of the resources as KCB, financial resources, and also my expert resources to be able to make a difference.
Thank you, Victor. Thank you very much. Sandiip, where are you looking to focus your attention within your sort of impact areas?
Yeah, Andrew. Let me just start off by saying that India plays a very important role in global greenhouse gas emissions. And in order of magnitude, as you know, it's China, India, and the United States, and India in that order. And it seems that China's not, even though they've been talking a lot about buying into the narrative for climate change, there isn't a whole lot incrementally that's happening, or if it's happening, it's not being reported aggressively. So the entire world focus is now changed on how US is leading that. And US is very clear that it cannot solve the world's global climate issues without actually having India play a very important role in that. And therefore, India has decided to buy into the US narrative, and in fact was the first country to have actually given out a very, very clear date or a deadline by which it would meet its net zero targets. So effectively solving India's greenhouse gas issues and climate emission issues and mitigating climate in India has significant impacts on global climate mitigation. Now, what's really interesting about the Indian narrative is that relative to other countries where, there's energy transition plays a very, very important part of global greenhouse gas emission story. In India, what we consume, how we produce what we consume, and how we travel accounts for 2/3 of greenhouse gas emissions. So in India, effectively, when you invest in food tech, ag tech, and mobility, you pretty much help solve 2/3 of India's greenhouse gas emissions. So what we're doing as a fund and as a firm is moving away from anything that's politically sensitive and focusing on areas where growth is inevitable and is clear for everyone to watch. And therefore, most of the investments that we've made has been, in, like, for example, we've invested in a very interesting hydroponics company, which actually was a winner in the MB100 list as well. I think they may have presented before, called NutriFresh. We've invested in a battery swapping network, which has now become India's largest interoperability battery swapping network. We've invested in a ride-hailing company, which is really pushing the limits on competing with the existing incumbents like Uber and Ola, because they're an all-electric commercial fleet. So our entire portfolio has been based around the ecosystem around these three themes. And the great thing about India is this country of 1.5 billion people. So the number of founders who keep coming up with interesting ideas is quite prolific. So we've been lucky in that regards, but that's how our portfolio is effectively built.
Thank you, Sandiip. And Medea, how are you thinking about 2023? What's interesting to you? What kind of companies are you particularly looking for if there is very specific focuses areas?
Yes, and if you allow me, I'll step back for a second. So first of all, I have to add, as a founder of C3, it's been 10 years. We have been excited about similar sectors, education, healthcare, anything that contributes to the SDGs have been our focus for our accelerators. And frankly, that has not changed. I think the world has changed during COVID. The awareness of the need for businesses to get into that agenda and contribute, and also the opportunities they had, is not something we need to explain to anybody anymore. So that's the exciting part about 2023. No more discussion on definitions of impact-driven entrepreneurship. I'm glad about it. When it comes to venture capital, so I've been working as a partner at Global Ventures for about 5 years now. We are the third fund. So the first fund, and they're all agnostic by definition, but the first fund was, in the end, included a lot of B2B software and a lot of fintech. Back then, it was the good time for financial inclusion, picking them at an early stage and kind of help them go through the hockey stick that a typical commercial venture capital firm will look for. A lot of financial inclusion companies in Fund 1. We have already exited 5, DPI 0.7, so we have returned on almost all the fund, only with a portion of the exit. The second fund, Vintage 2020, ended up with, again, a lot of financial inclusion companies, but a big proportion or a big portion of our companies are actually in digital health diagnostic. I guess it's a little bit the COVID effect, performing super well as well. And then we have one agri-tech and a few ed tech, and a lot of B2B software again. For Fund 3, which is what we're excited about now, we are really focusing to anchor the fund into 4 areas. One is supply chain disruption. In particular, in our part of the world, the COVID have, let me say, shown that having 95% of, and I'm talking about the Gulf, 95% of food imported, it's not a great long-term strategy. So a lot of innovation is happening there at a supply chain level, at a food and water security level. When it comes to North and Sub-Saharan Africa, we're super excited about energy tech. In Sub-Saharan Africa, particularly renewable and wind and solar and grid innovation at a software level and else. It's super exciting as well. So I join my fellow panelists on the excitement on that side. But I would say a lot of digital health will still be of interest for us. There is so much else that we can do in that space, so we're not moving out of that. I think financial inclusion has gone through a tipping point already. So eventually, the big banks are now focusing on that as well. So it's good time for exits. We are looking forward to that. But I would say when it comes to the valuation drop that we have seen globally in fintech, I think it's a little less exciting than it was 2 or 3 years ago for venture capital that, you know, focus on early stage. I hope I gave you a perspective of what we're excited about. Thank
you, Medea. In terms of big idea ventures, what are we excited about for 2023? From our point of view, food is one of the biggest levers, whether that's in seafood, you know, meat, dairy, et cetera, if you look across, you know, what's impacting climate change, transportation is one of the largest areas. Food is up there, right up there alongside transportation. So from our point of view, being able to invest in companies in the food category gives us one of the greatest levers against climate change and global warming. So we've invested to date in alternative protein, so replacing animal factory farmed meat, taking animal seafood and related from the ocean, and dairy. So we're looking to bring new innovations in those areas to the market, and also technologies that will facilitate change in the alternative protein category. From our point of view, our first fund, New Protein Fund 1, is very much focused on replacing animal factory farming, overfishing of the oceans, and you know, the gas, etc., of dairy and related. We believe, you know, we found some amazing innovators across that entire category who can give consumers what they're looking for. So bioidentical replacements of meat, seafood, and dairy, but in a far more sustainable way. And that's one of the key drivers. The second fund for us in 2023 is actually commercializing university intellectual property. So venture building, creating new companies by partnering with universities and taking IP out of those universities and bringing new companies, new innovations, new technologies to the world. That's a global exercise in both of those funds. Now, what we wanted to do as a team, and we spoke about this before, is to bring some really practical advice and suggestions to anyone listening who's actually in the entrepreneurial area and is looking for fundraising. So, Medea, I don't know if you want to kick this off. From your point of view, what can entrepreneurs do better to raise funds from venture capitalists, from other investors out there? So give us 1 or 2 tips for entrepreneurs who are listening today in terms of raising money from investors.
Yes, with pleasure. I could go for 20 minutes, but I'll try to pick a couple of things that in particular in this moment in time are actually happening quite often. So the first will be, don't wait until your runway is really short. Start when you don't need the money yet, to engage with investors, to engage with impact investors, with any other source of funding, because it takes time. It takes time to find the right match for you, to find the right investors, and for the investors to evaluate you among a lot of other entrepreneurs. So maximum 6 months before you should have already identified a lead investor, 6 months before running out of cash, just to be very clear of what I mean with runway. The second will be, make sure you do your research and make sure that what you are pitching to a specific investor is relevant to them. And even if an investor in that moment in time might not be ready to sign the check, keep them posted if you see some interest in your business model. Sometimes it's just a little bit early, sometimes it's not yet the, let me say, the right geography you guys are in, but investors are raising funds and each fund might have a different mandate. So make sure you engage with investors very early on and you keep them posted, even if they said no in the previous round, or even if they haven't followed up with you directly. So I would say these would be two pieces of advice. I have many others, but I'll let the other panelists go for it.
Yeah, don't take all of the tips away from everybody else. Leave some on the table. Sandiip, give us a couple of thoughts on that.
Yeah, actually, this is a great topic. I'd actually like to say at the very outset that impact is recession proof. So if you can actually demonstrate to an investor that you're actually an impact company and not pivoting to impact because impact has capital behind it, you can actually get access to capital. So when you actually go out to pitch to investors, make sure that you emphasize your impact metrics. So have some calculations out there that you can actually show to people that you're actually an impact company. The second is, how they say in real estate, location, location, location. In the case of venture companies, I would say structuring. So growth is obviously something that all of us look towards while we invest in startups. So work backwards, provide confidence to investors that they're actually investing in a company and you can actually deliver that growth if the capital is there. I've had unique situations where where companies have come to me with order books saying, don't give us your capital for us to go out and then get orders. We already have the orders in place. So if you give us the capital, we'll be able to execute on those orders. That for me is a bigger level of comfort when I invest, because I know that that capital, when I invested, is not going to be used up in expenses, in paying salaries and keeping the company as a going concern, but actually going to be used on executing real orders. The other one point which is very important for a startup is the typical startup issue, which is, do I sacrifice ownership by giving away a lot of equity early on because I need the money? My point there is, take the risk. Don't worry about events that are not going to happen. So liquidation preference is something that people are always worried about. I don't want to give a 2x liquidation preference. Well, if you're not worried about your company going under, don't worry about giving that liquidation preference out. Don't worry about giving additional equity out. You can probably bring in a point to say, if I deliver on growth, can I earn back the equity? So we've actually worked with companies where the founders are giving up a larger part of the equity upfront, but we give them an option to actually earn that equity back as they deliver on that growth. So interestingly, those companies that structure well are able to demonstrate impact by actually providing an ability to measure it. And one last thing, instill confidence by building an incredible board, because people don't know you as a startup, but they may actually know your board members if you have really good people on your board. So I'll leave it at that. I mean, there's a whole bunch of points still more, but I'll leave it to Victor and Andrew to talk more about those.
Fantastic. Thanks, Sandiip. Victor, what's your 1 or 2 tips for founders?
Great. For founders, I think the first one is a bit mentioned, but I just want to emphasize that founders should be able to market their solution. The product that is and the service that is being purchased out of you by customers and by clients is the solution that you provide. And that is enabling people to live better than they live now. So that's very important. That should be very clear to an investor. Contributions made by impact investors are about, if it's about climate resilience, if it's about improving livelihoods, whatever sort of thing is it has to provide a solution. It has to be a package of things. I think the next one is about, precision. Know really what you want, right? I know there are investors who would want to, sometimes, push founders to certain corners so that you access their money. But I think it's more important that you sell your idea to the investors get the investors who are interested in your business and can grow with you, as opposed to changing your way of doing things and idea from time to time to be able to get money anyway. So I think most founders get distressed when they have gone a long period of time without getting money, and though sometimes they're influenced to, to tilt a bit so much that they can get money. It only ruins your business, because then you'll only be palatable to one investor. And a last one, please speak to the investors even when you don't need money. Yeah, just keep speaking to investors so that the investors within your space know what progress you're making and know how you could be ready for them in the next few months or 1 year or 2 years. So just knock in, tell us what's happening, even when you don't need money, even when you already have, sometimes you have enough. So that's what I would tell the audience now.
Thank you, Victor. The last two, from my point of view, 2 tips. One is, and Victor kind of stole one of Medea's. I'm going to steal one of Medea's as well, because it's just such a good piece of advice. Make sure that the investor you're tackling or talking to actually does your kinds of investments. So in other words, do your research on the investors before you start reaching out, before you start engaging, sending emails, etc. So we're focused at Big Idea Ventures right now, and it will change over time, on food and agriculture. That's our focus. I get reach outs from founders on egg tech, fintech, AI, just all sorts of random things that we just will not invest in because it's not the pot of capital we have available. So if you're in fintech, ed tech, whatever, you're wasting your time and mine by reaching out to me, asking me to invest, because I A, don't, and B, can't. So what you really need to do up front is just make sure that you've got a list of investors who actually invest in your particular area. I know it sounds super simple, but I think that's a really good recommendation. And also, when you're reaching out to a very specific person, and normally you're engaging with an individual, a person, make sure that that person not only is part of a firm that invests in your area, but is actually interested in your particular area as an individual, because you're much likely to be able to engage. The second piece of advice is one of chemistry. So yes, you need money to survive. Money is oxygen. But you really need to make sure that you're partnering with the right investors and that their motivations and their goals are the same as yours. So don't just take a check because it's money and you need it. And I know that's super easy to say when you have money. It's very difficult to do when you don't. But you really need to make sure that there's a chemistry and that there's a full alignment between your objectives as a founder of a company and the investor, because if you're focused on changing the world and they're focused on making money and that's all they're focused on, there's a dissonance and it's a challenge. So you need to make sure that there's an alignment. It's really important for the long-term success of the company. Now we're going to get into one last piece.
And one point, just one quick question on that.
Yeah, go ahead.
Keep the interaction a little bit more fluid. What's happening in India is that sometimes founders have access to just the type of investors who invest in their business, and there's a lot of competition. So sometimes what I do tell the startups is to actually cast a wider net. So always reaching out to somebody who only invests in your industry or knows the kind of companies that you are may not necessarily, at least my own experience has been, when you cast a wider net, even if I don't invest in the sector that the company that's looking for capital reaches out to me on, I can actually refer them to somebody else because I know that they're in the market raising capital. So sometimes reaching out to a wider net of investors who don't necessarily invest in your sector may not be a bad thing. You don't do it too often. But if, for example, you do have access to that wider, if you don't have that access to the wider net, just reaching out to someone who has invested in your company or does not invest, you can get a referral to someone else, is my point.
So I think that works when, like, for example, you're reaching out to a board member and a board member has a wide portfolio of interests and relationships. then they can connect the dots. But if, for example, you're a fund that's specifically focused on food as food and ag, which is Big Idea Ventures, reaching out to me saying, hey, we're a fintech company looking to, I don't know, do crypto or something, I haven't a clue who to introduce them to. I'm just so deep in my category. Now, if I was in technology more broadly, yeah, maybe so. I think you're right. When I think I'm trying to encourage founders to be a little bit more precise in who they're reaching out to, and just as opposed to just downloading a 1,000 investor list from somewhere and sending 1,000 spam emails to 1,000 investors and hoping something sticks. I think that's a waste of their time. It's probably a waste of the investors' time. But cast a wider net in terms of business people, board members, etc. I think that's super smart. We've only got, I think, Tom, if you can just type how long we have, I think we've only got about 8 to 10 minutes left. One quick question before we turn it over to Q&A. What is your advice to entrepreneurs who are faced with limited funding options in their either category or region? What suggestions would you make to them? Victor, do you want to start that one?
Great. I would start that, and I want to make two straight comments. One is that it's important for founders to understand what their growth roadmap is, and I think it's very good for them to be to value organic growth. And so even in times and geographies and cycles when they have limited financing, they should be able to deploy what they have for very catalytic activities that can keep them running. So I think the entire idea is to ensure that you are operationally sustainable, even though you may be having some financial or cash flow crisis, or you are unable to raise within good time. The second one is about in most cases, and I have observed across board, staffing, rational and optimal staffing has been an issue to most founders. So the moment founders raise more money, some of the material things that they would want to get into is a big office and look presentable in the office and hire more people, even though it's not optimal to do so. So lean organizations, I think, has been a very good approach that has helped most founders to step so steadily in a manner that helps them, one, to preserve the resources that they have, but two, to also develop very solid foundations in terms of efficiency and effectiveness. So that's what I would advise. But then the last one is that fundraising should not be an event, right? Fundraising should not be an event, it should be a regular activity, and so it needs to be very much maintained in all the activities the founders do. Back to you, Andrew.
I think that's an incredibly good piece of advice. It's not an event, a one-off. It's something you should be thinking about on an ongoing basis. I think that's fantastic advice. Medea, do you have a thought on that?
Yes, I've seen a lot of type of funding sources, in particular when it comes to companies that have a strong impact mission aligned with the business, as well as a business model which is solid revenue growth and so forth. Now, first of all, in particular in this moment in time, having a path to profitability is very important. And if people can avoid the fundraising in this moment in time where valuation are actually quite low, I would say it's not a bad idea if you can. If you cannot, for impact-driven entrepreneurs that have a solid impact measurement system and they have proven their impact already, there are grants, there are FDIs that invest directly, in particular in our regions. I think there are plenty of them. Watch out to the terms though, because if the terms are not very VC friendly, then it's very difficult to go for the next round with the commercial VCs. Again, we could speak about that, we could discuss that for half an hour. But the second area to look for funding, it's also venture debt. If, again, it's a B2B business, for example, with revenues contracts that eventually put some pressure on cash flow because of payments. There are some options now from traditional banks, but also for newcomers. One that comes to mind is Partner for Growth, for example. Then you have a revenue-based commitment plus cash for equity that could work for some companies, like content-based, education, subscription-based companies. That could be another way. And then, of course, there are grants. There are other funding sources that could be helpful if the companies are really impact-driven. Bootstrapping is another option. I know it's not something that founders always think about, but frankly, I've seen some very successful company fundraising when they reached the level of a Series C of another company, and it's beautiful to see because they get very good terms. They don't dilute the founder shares as much, and why not? It might take a little bit longer. It depends on how competitive the market is and how speed to market is a competitive advantage, I think. I hope this is helpful. It's very theoretical, but there is one book that I read recently, and I don't know the author, so I hope it's fine to share the title. It's called Adventure Finance. There are a lot of other ideas there for impact-driven entrepreneurs. I highly recommend it. It's a little bit technical, but it's helpful.
Thank you. Sandiip, I think we've only got a few minutes. So
yeah, I'm going to provide some practical advice and go back to the last point, which is money doesn't always come from VCs. Cast your net out as wide as possible. Point number one. This is why I said that in my earlier point, but also don't feel shy to ask for referrals. So when you reach out to people, you're like, okay, well, do I ask this person for money? No, if you don't ask for it right now, it's a question of survival of your business. The other thing is, you don't have to actually give your pitch yourself. You might actually be going out to a VC for the first time, and that VC might not react, but the VC actually constantly is in touch with the capital raising ecosystem, which means investment banks, other agencies. So use an investment bank or an agency to raise capital for you. Even if you have to give them higher fees, do it. But I've actually seen a lot of smaller companies in India now, which have high growth trajectories, reaching out to third parties to raise capital for them. Family offices play a very big role now in the entire ecosystem. So VCs are now competing parallelly with family offices there's lists of family offices out there. If you can actually subscribe to a service that gives you access to family office information, do that. And then lastly, but not the least, is accelerators and incubators. Accelerators obviously are more focused on building out an ecosystem rather than raising capital. So they'll always have access to resources. So, see if you can actually get into, the membership ecosystem of an accelerator or an incubator, and then leverage those resources to get access to capital. So in a nutshell, that would be sort of my advice.
Amazing. I've got a couple, and then we're going to have one last question, and then we're going to say goodbye to everyone. So a couple of pieces of advice. One is, and I've raised money as an entrepreneur. I've started at least 2, maybe 3 businesses. I know exactly how many, but it's, I've raised money as an entrepreneur. I've had my ramen noodles for 6 months with no real food. I've done that. So one thing that comes through is, if you want to raise money, ask for advice. If you want advice, ask for money. And that sounds really weird, but when you go out and you're just asking for money, generally you get people telling you all the things you're doing wrong, all the things that aren't so great in your business, and they don't give you the money. If you actually go out and engage with people and start talking to them about your business and what you can do better and how you can make your business succeed, and you engage them in that conversation, often you'll find people that want to write you a check. And I know that sounds very strange, but if you want money, ask advice. If you want advice, ask for money. It's very strange. The other idea is, when you're talking to investors, don't try and close them. People don't like to be sold, but they do like to buy. So what you should be doing when you're engaging with investors, any investors, is just trying to get to the next meeting, just trying to get them excited enough and engaged enough that they want to continue the conversation. Don't walk into every meeting thinking that you need to walk out with a check. It's unlikely to happen. It's a process. So those are my last two pieces of advice. So we've had a couple of things. We've had people talking about plastics in the chat. We've had people talking about the energy crunch globally. We've had people talking about the oceans. What are you guys doing, if anything, in any of those areas? And are any of those areas going to be something you focus on in 2023?
I mean, I could take a stab at it. We're looking at a circular economy company. Obviously, plastics and dumping of plastics in the ocean is a very, very big area of concern from a climate change perspective. And we're considering, for the first time, going out of those three areas that I initially talked about: food tech, ag tech, and mobility, and now looking at some circular economy plays. We're looking at this company in India, which actually makes an alternative to plastic for single-use plastic bags. And they're actually using a biodegradable material where, you know, that becomes a replacement, and you dump it into the ocean. Even if you do, it actually lowers the temperature in the ocean, becomes food for the fish. And, you know, there's a much better solution to that issue than using single-use plastic. So yes, we're looking at that.
So plastic is an area of focus. Victor, Medea, are you guys?
Just make a quick statement. We have invested in a plastic recycling business, now running for the last 3.5 years. We began when they were at a startup stage. And I just want to reflect two facts. One, we have seen a lot of change happening, of course, when the government moved in to, tighten the regulations in terms of, producer responsibility. So in Kenya, the government recently, instituted a waste management bill, which actually holds accountable, production and towards the entire, addressing certain specific value chain things. We have seen now, that company is growing better. But most importantly, I think the most important thing is to look at the aggregation, how the plastic waste is gathered in a manner that creates adequate volume for business. That's still the biggest challenge. And if a lot of investments can go into that area, and that's one of the areas that we want to focus on 2023 going forward, is to build capacity for aggregation of adequate volumes that can make business sense for enterprises. In terms of the blue economy, so it's an interesting part. We have not invested already, but it's an area that we are looking at, both freshwater economy and the oceans as well.
So I'm looking at Tom, who's looking a little stressed. So Tom, are we done now, or do we?
Well, I mean, we're done. The time is gone, but
okay,
we've probably got time for another comment from Medea and yourself, Andrew. Go on.
Medea, one last, if you wouldn't mind.
Yeah, sure. We have looked at a lot of companies that are doing exactly what Victor was mentioning, and we help them through our accelerators. We have just started investing in solutions that are very environmentally meaningful. One being Red Sea. It's a company in Saudi that has expanded in Arizona recently that grows crop with salty water and solar power in the desert. Same nutritional value, same yields than the best you can find out there. That of course helps also not importing as much food as you would imagine in this part of the world. Another company we love, it's Max in Nigeria, mobility company that went straight into EV because it's just less expensive and requires less maintenance. And again, all those technologies are now very commercially viable compared to a few years ago. So we're seeing a lot coming. And then one last that I cannot mention because we haven't invested yet, we're looking at it as we speak. It's a 3D printing software that basically disintermediates all the imports of products that again, it's a huge carbon emission problem around the world. So supply chain disruption and decentralization is something we look at from an environmental perspective as well. It saves a lot of CO2 emission in the world. So hopefully we'll contribute as much as my fellow panelists in the environment as well as we have done in financial inclusion and healthcare.
Fantastic, Medea, thank you. So last comment, on the seafood side, we've invested in Shock Meat, which is a biotech company, in shrimp, aquacultured food, which is replacing white fish and shrimp using fermentation. We've actually invested in probably about 10, 15 companies on the seafood side. But more important than that, my last thought is, it's one thing to look at investors in the impact space and think it's our responsibility, or the companies that we invest in and think it's their responsibility to solve the challenges around climate, global warming, sustainability, and so on. But the impact we're having on this planet is made up of micro decisions that we all make as individuals on a daily, minute-by-minute basis. And every dollar, every krona, every euro, et cetera, that you spend is a vote for the company that you're buying the product from and how they produce and source their products. So every decision you make is a vote for either a good company and what they're doing, or a more challenging company and what they're doing. So you are the power driver. You are the decision maker when it comes to our climate, when it comes to our world health. It's not just the $10 million that we spend. That's just a tiny drop in the ocean. If we all do the right thing, then we're going to have the kind of planet we're looking for. Thank you, everyone. Thank you, Medea. Thank you, Sandiip. Thank you, Tom. Thank you, Victor. You've all been amazing.
Thanks, Andrew. Appreciate it.
Thank you so much.
Thank you, Andrew, and very well said. So thank you again to our panelists, Medea, Sandiip, and Victor. That was brilliant, and exactly the kind of session we'd imagined, full of actionable, kind of practical guidance to entrepreneurs. So I hope everyone listening found that useful.